Good morning and welcome to the market view for Wednesday the 25th of June 2014. And looking at the 30-minute chart, we can see we have a potential sell signal there that was filled and the market moving lower. However, this was at 9:30, and as I advised in yesterday's market view, as Del Boy Mark Carnage was going to be speaking about the CPI report from the previous month and the prospects of increasing interest rates, it would probably be wise to stay out of the market. This one, a particular sell signal here, actually worked out in our favour. However, it could have also gone the other way as well, so it was best to stand aside. So Mark Carnage can't decide on whether to increase rates sooner or later. I've never known anybody change their mind about so many things in such a short space of time. And it's not just me now. MPs are saying that he's like an unreliable boyfriend. He can't make a decision. He won't give any concrete information. And the reason for this is quite simple. There's a bigger picture at work here, and most people will not see it. Most people think of interest rates and households paying the increase on the mortgage payments. But of course, what people don't realise, and there's a brilliant article that was in the Daily Telegraph on the 22nd of May, is that the interest bill on the UK's 1.27 trillion debt to hit 1 billion per week. So if interest rates go up, of course, it's going to increase the interest that we, the taxpayer, are going to pay on this debt-based economy and QE money to over 1 billion per week. We're currently sitting at 75% GDP to debt, and you cannot pay off a debt with 25% against 75%. It's absolutely impossible. So this is the reason, in my opinion, why interest rates are being held back, because it's going to create a far bigger debt burden for the taxpayer, and it puts them between a rock and a hard place, because on the one hand they want the economy to turn around and start looking like it's actually real and the growth is real, which of course it's simply not. And of course, when they do this for political reasons, i.e. election next year, they are then faced with the task of having to increase interest rates. But of course they don't want to do that because it will increase the interest on the debt payment, which is already sitting at 1 billion per week now. So for me, this is the reason why they're holding back, or Mark Carney is holding back on increasing interest rates, because it's going to impact on the interest payment on the debt, which is increasing by the day, not decreasing as well. So beware wary of comments like the deficit as being cut by a third, which you will hear Cameron talking about, which is absolute utter tosh, because deficit and debt are not one and the same thing. Deficit is a reduction in the income to expenditure, whereas the debt is what we see here, 1.27 trillion debt. And of course, it's the interest payment on this debt that people are missing. So anyway, that little digression there, I believe, is the reason why we are seeing this vacillation on Carney's part to delay increasing interest. It's nothing to do with the mortgage payers or anything to do with the economy. It's to do with protecting or trying to keep the interest payment low, because it will blow the figures for everything that Osborne here has projected, still borrowing all the way through to 2019 in the last budget. And of course that's increasing with the 1 billion. So that's 52 billion a year that is has to be found, printed or otherwise, to pay the interest on the debt. So keep this in mind when they're talking about interest rates, how it impacts the bigger picture there. So let's go back to the charts. The market rebounded a little, no buy signals, and then traded down. So the market coming back below $1.70 yesterday and trading down towards the 169.50 there. And at the moment, yesterday's low at 169.55 there. Sorry, it's at 65. So stuck in this sort of sideways range as we have been for some time. In the daily charts, you can see the market's down for yesterday on Carney's comments. That's the indecision that's created this down move. because he can't make up his mind. The market going through the 76% retracement and heading back now towards the 169.50 area there. So let's have a look, see what we've got as far as the downside target is concerned. We've got this low to this high, and you can see there we're at the 62%. The 76% is 169.52, so 169.50 there for the downside support should the market move lower. On the upside, let's just draw in what we've got from there to there. If the market turns around and moves back up, they're the sort of areas you'd be looking for the market to find resistance to the upside. 170.25 and then 170.38 there. So that's what you can see as far as the range is concerned today, profit targets, and I'll just save those so we've got those for tomorrow as well. In the news, let's have a look. Nothing for the UK or Europe this morning worth looking at. Final GDP quarter on quarter 130. That will be an interesting one. It's forecast again to see. This is what drives me around the bend with the mainstream media talking about the GDP figures are great, the economy's turning around, and Yellen was talking about this the other day. She said she was going to taper by another 10 billion. Says the economy's growing. Then it was followed by slowly, and then you look at the forecast today, we've virtually got a 100% decrease from the previous, from 1.0 to minus 1.8. If this comes out at -2, then expect a big drop in the Dow, because what we're tapering, well, alleged tapering, and the GDP, final quarter GDP, from -1 to minus 1.8 is something else. So keep an eye out on this one at lunchtime, and I would advise to stay out of the market just in case it comes out far worse. And then core durable goods orders out also at 1:30. Okay, let's take a look at the Dow implied for yesterday. Just before we look at the underlying market, we can see we're starting to move back to the upside, so we could be on the cusp of a correction coming in the market. You can see they're increasing to 9.3, coming off those historic lows for the implied volatility there at the moment. As far as the market is concerned, down 119 yesterday. And I received a question yesterday asking why my chart looks different to that of MT4. And the reason is that the data contained in here is mainly the day session, and doesn't include the overnight, which is from 2:30 to 9:15, which is the hours you only really want to trade the Dow anyway. So we can see yesterday the market trading up to 16,970, and then the market's pulling back. And if we go from here to here, you'll see why it stopped where it has actually stopped, at 16,808.74. That's 76% retracement. And what I will be looking for now to confirm this weakness is from the high to the low. Any rally back to this area now, I will be looking to tuck underneath the rising lows to actually go short in this market, because we've got the implied starting to increase, so they're starting to see some sort of risk at these levels. Maybe we're not going to get to the 17,000 I was hoping so, but again, those GDP figures are out today. If they come out at 1.2 as opposed to the forecast of 1.8, then the market could see a big move to the upside. So we don't know what's going to happen until the GDP figures are released at 1:30 today. Right, well, that's it from me for today. All things being equal, I will be here tomorrow. As ever, thank you for your support. It's very much appreciated. Let's hope that we're starting to see something happen in the market so we can get some trades in. It's certainly been barren of late, and it's no good for any of us. So fingers crossed we're starting to see some activity come into the market. Okay, as ever, thanks for watching. See you tomorrow.